and bring on board the management of Mastek. We're going to understand what the order backlog is like, and there's also some corporate development where Mastek is trying to now reduce its UK exposure. Hiral Chandrana, the global CEO of Mastek, joins us now on the show. Hiral, thank you for taking out time. Let's start off first with the delay in the UK decision making. It's something that you spoke about in your last conference call. If you could throw some, I'm asking you a very pointed question right up front, but if you could throw some light on that, on what the UK business update is like right now.
Sure, absolutely. Are you able to hear me okay? I'm not able to see you. Are you able to see me and hear me okay, right?
Absolutely, Hiral. We can hear you well.
Thank you. All right, fantastic. So interestingly, I was in UK this past week, spent a few days there, and we have a fantastic business out there. We are working with the leading public sector institutions, as you know, Home Office, as well as the National Health Service as well. And we're doing some very cutting edge work. So I just wanted to maybe correct a little bit upfront, saying we are by no means going to reduce our UK exposure. That's a very healthy business for us. In fact, we expect to continue that run in many areas, including the private sector in UK. So it's a booming business and will continue to do so for us.
I stand corrected then. Apologies on that front. Let's talk about then, the order book, the kind of order and demand that you've been seeing compared to, well, let's not look at Q1 maybe. The June quarter, of course, was marred with a lot of difficulties. But what have you been seeing in Q2 so far? What's been the demand and the order outlook like?
Sure. Yeah, I mean, Q1 that ended was a good quarter, as you know, for us, and Q2 we are seeing some good momentum. The size of the deals have been increasing as well. So we are, based on the credibility and the successes that we've had, we're getting involved in larger sizes of deals, and partly that is because of our combined entities with the Evosys and the cloud business that we acquired last year, combined with the broader Mastek digital services. So that combined proposition is creating and helping us with some of the larger deals. So momentum is good in terms of deals. There are some delays in some cases, particularly when the deals are larger, you'll see a little bit longer cycles. It's obviously going to be more competitive. But we like the position because we've been in the business of delivering business solutions. And that's really where customers are looking for higher value now.
Right. Hiral, what I want to talk about is, the growing problem of attrition. And this is something that we've heard from, across the IT industry. That's clearly risen sharply. You've taken a salary hike in the second quarter as well. What's been the quantum? Are you still on track with margins at around 21% in FY22? Or do you think they're going to get a little weighed in because of the salary hikes?
Yeah, so we let me first address the people part. It's definitely a challenging talent market, as you know, but we've taken a lot of steps, not just in terms of our salary hikes that we provided this quarter, but also in terms of skill transformation, looking at various elements of how training is done and reskilling is done. And of course, the employee experience part of it. So that's as far as the people angle. Now, I think our CFO, ex-CFO was on your show about 12, 15 months back, and our margins were in that 13-14% at that point. Now we're at about 21% or so. So we've had a healthy growth. We feel comfortable in that 20+% operating EBITDA. There's going to be some fluctuation, I'm sure, quarter by quarter, but we feel that we've had some good leverage in terms of fixed costs and comfortable, in that range of about 20%. We don't guide numbers, as you know, but we don't see any issues in that range.
Sure. But are you able to pass on the salary inflation onto your clients?
See, there are 2 or 3 parts of our business. As you can imagine, there are some elements of time and materials work that we do, which is based on rate cards, which is based on pricing, which is directly people-based. there are certain parts of our business which is really based on fixed priced as well as delivering based on business KPIs. In fact, some of our cloud implementation business, which we acquired through Evisys, actually majority of that work is delivered with business outcomes. So there are elements of pricing and realization that we can leverage on based on just the outcomes that we deliver. In some cases, the skills that are high in demand, customers do realize that they need to be paying more for it. So from that perspective, there are certain skills where we can command higher prices as well. So it's a combination of pricing power on the rates as well as some of what we deliver in fixed price.
Okay. There is a belief in the market, and if it is true, let's discuss it. If it is not true, I would encourage you to dismiss it. And the belief is that typically when you are in a boom time, the migration of talent goes to big IT companies. And that's natural because of brand ESOP or maybe the salary hikes. And smaller IT companies, they tend to suffer. I'm bringing this point out because this is a widely discussed point amongst analysts, shareholders, and some of the market men I speak to. Is this a concern and a real concern for mid-cap IT stocks, mid-cap IT companies? Would you like to challenge it or dismiss it or agree with it?
Sure, Nikunj. So let me talk about the customer mindset, because I think that's the best way to look at it. In the end, we're serving the customer. In fact, like I said, I was in UK for a few days, met a few customers. So the business is getting a lot more involved in the technology roadmap. In fact, one of the financial services customers that we met, the meeting was set up with the CIO, but the CEO of the company joined that meeting. And there is a lot of interest from the business about how the technology is going to help the business transformation. So, Mastek has always been in that business of digital and business solutions. So we like that positioning. And the IT groups and the CIO particularly is getting a strong seat at the table right now with the business. So I don't want to necessarily comment on the mid-cap versus the large IT players. I think it's the difference in how we position ourselves. We've been fortunate that about 85% or so of our business, or even more now, is really about digital and cloud services. And we're impacting the business directly. And some of the customers I talked to you about, NHS, we're doing thousands of calls of automation during the COVID relief. We automated a whole bunch of backlogs for immigration and visa processing for the Home Office. We've developed a DNA database. We're doing some very cutting edge work. So we're directly working in many cases impacting the business. So we don't see any challenges in terms of large versus mid-cap in our case. I think it's about the credibility and trust you're building with the customer and the value you're delivering to the customer.
Really appreciate that. My next question is that while every IT industry, and when I speak to their representatives, they are using words like gangbuster, boom time, unprecedented demand, golden era, things never seen like this before. How much of the current business is a pure sugar rush, which is that a 3-year cycle has got contracted to 2 years, or a 5-year cycle has contracted to 1.5 years. And after that, it may not be a boom time. I mean, it is just that the outsourcing, which was supposed to grow at a certain rate, has got preponed.
Yeah, Steve, let me put a slightly tangential spin to that, Nikunj. I think earlier in the show, you were talking about HUL and the digital adoption of HUL as an example, right? That was FMCG. The same applies to healthcare, manufacturing, other industries as well. So what's happening is many of these enterprises and customers are going through this digital adoption, and they're changing business models. They're changing their supply chains, like you already mentioned earlier. So as part of that, right, there is a huge transformation, and technology obviously is a big enabler to that. So we see, at least for the next 1.5, 2 years, this transformation continuing. In many cases, in many industries, it's still at nascent stages. There's a huge opportunity for automation. There's a huge opportunity for digital adoption. Cloud has taken off, obviously, in a big way, and we're investing heavily in that space. So for us, the next foreseeable 18 months to 24 months, we see this happening. I would say beyond that, when we look at what I call Horizon 3, that's where I think new revenue streams will emerge. And that's an interesting element of how companies will get ready for those new revenue streams. We are already investing, keeping a medium to longer term view in mind, because after 2 years, some of that digital adoption would have reach some level of equilibrium, and then the next cycle would begin. And so that would mean more AI, more intersection between industry and technology, different business models and monetization models. So there's going to be an interesting phase next few years, I would think.
All right. Well, Hiral, we leave it at that. All the very best then as you enter this new and interesting phase. Thanks so much for joining us this morning on The Market.
Thanks for having me.